Hello, I'm Andrew Zbik, Senior Financial Planner here at Omniwealth, and welcome to our Investment Committee update for March 2018. Let's start with Australian and international share markets. And you will recall our commentary last month explaining the reasons for the sudden market correction in early February. And in true share market style, most share markets around the world ended the month of February on par with where they started. So talking about the strength of the world economy, we think it's important or interesting to note that a vast majority of countries around the world are experiencing economic growth of between 2 to 4%. And this is quite healthy. In fact, the only countries currently in recession are Venezuela, Puerto Rico, Equatorial Guinea, South Sudan and Swaziland. So that gives some perspective that the global economy is in a pretty healthy position. Now, February marked the end of reporting season locally here in Australia. And this is where out of the top 200 companies on the Australian Securities Exchange, 135 of them announced their half-year earning results and 35 announced their full-year earning results. And there are some interesting facts to take out of this reporting season. Number one, a record 94% of companies produced a profit, and this is above the long-term average of 87%. Secondly, 87% of all companies elected to pay a dividend, and again, this is just above the long-term average. So we continue to advocate that clients start to make monthly contributions to their share portfolios where cash flow permits. For our clients who have portfolios with Republic Wealth Management, you will have noted a number of trades were made over the last week. There were two sales. That was the iShares Global Consumer Staples Exchange Traded Fund and the Dow Jones Global Real Estate Fund. The Republic Investment Committee deemed that a defensive allocation to global consumer staple companies is no longer warranted. And secondly, given that global property markets are peaking around the world, it was deemed appropriate to move away from this sector. So the proceeds from these sales have been invested into two new ETFs. One, the Eurostoxx 50 Exchange Traded Fund and the iShares MSCI Japan Exchange Traded Fund. Both ETFs increase our exposure to Europe and Japan. The Eurostoxx ETF invests in the top 50 companies in Europe by market capitalisation, and the Japanese ETF provides an exposure to the top 321 companies listed on the Japanese stock exchange. We continue to see more pressure being placed on developers, and this is helping to restrict new properties coming onto the market in Australia. Banks are requiring that developers pre-sell most of their project before any finance is released to commence construction. And we also note again that in this month there is some negative coverage in the media about the roles SMSFs play in the property market, and this is something we watch closely. It's always important to look at any statistic and how it is presented in the context of the whole market. So, for example, stating that there's been an 18% increase in loans for SMSFs to buy property seems quite staggering. However, SMSFs make up around 30 billion of all loans on issue, and in Australia there's 1.73 trillion of loans in total. So SMSFs make up about 1.78% of all lending. However, a lot of this money is also used to buy commercial and share portfolios inside super. So as you can see there, SMSFs make up quite a small portion of lending. Likewise, SMSFs own around 34 billion of residential property in Australia. The total residential property market in Australia is worth $6.78 trillion. So SMSFs make up only about 0.5% of all residential property in Australia. So as always, we advocate for clients, if they are using their SMSF to buy an investment property, that they make sure they maintain a healthy cash buffer and have some other liquid assets in that fund as well. In the lending space, we continue to see banks preferring to offer principal and interest loans for owner-occupied properties, and trying to obtain an interest-only loan for a home is becoming harder, and this is mainly as a result of the directions from the Australian Prudential Regulation Authority, the body who's responsible for regulating banks in Australia. We have seen some softening in the offering of interest-only loans for investment purposes, and it's important that when it comes to any lending strategy and purchasing assets for investment, that we recommend that people assess their lending capacity on an interest rate of around 7 or 8%. And this is what will help you prepare for a higher interest rate environment, which we believe could present itself in the next 3 to 5 years. So that concludes our market update for March. As always, if you have any questions about your strategy, please feel free to contact your Omniwealth advisor. Thank you.